We'll let everyone join. Thanks everyone for coming. Oh, yeah, we've got people trickling in, so we'll give a couple minutes. Oh, all right. What do we think? 11:02. We get going. That work for everyone?
Sounds good.
Right. All right. All right. I think we'll jump into it a little early, but welcome everyone. Thanks everyone for joining. This is one of Escalon's webinars, Scaling SaaS, Essential Strategies and Fundraising for specifically for SaaS founders. We'll probably spill over into some advice for, different business models, different industries, things like that. But to start the webinar, I'll introduce myself. I'm with Escalon. I'm our head of partnerships. I'll be moderating the discussion today. Just so everyone knows, Escalon's an essential business services firm. We provide, CFO advisory services, outsourced accounting, outsourced HR, recruiting, taxes, kind of everything that's not building or selling a product for founders. And with us today, we have Gabby Contro, who's a partner at Crosslink Capital, Scott Iyama, who's a partner at Orrick, the law firm, and then David Horning, who's Escalon's own head of SaaS. He runs our SaaS vertical. And to kick things off, we've got a couple sponsors that I'd want to introduce. We've got Tom Higginson from JustWorks. Tom, why don't you do an intro?
Yeah, thanks, Mike. What's going on, everybody? My name's Tom Higginson. I'm a partnerships manager here at JustWorks. For those who aren't familiar with JustWorks, JustWorks is a technology company that levels the playing field for small businesses and startups. We have both payroll and PEO software, and essentially how we help startups is we help them take care of their teams by streamlining their back office operations, navigate the complex aspects of managing a workforce, and we do that through all things payroll, tax, HR, and compliance. So really excited to be here. And I'll go ahead and pass it over to my colleague from SVB, George.
Hi, everyone. My name is George. I'm from Silicon Valley Bank. So I guess about a little over a year ago, we had a slight bump in the road. But best case scenario, we have a new parent company that came in for Citizens Bank that allowed us to be business as usual on the ground floor. So it's allowing us to go back in market, double down on our initiatives. So for my group, I'm part of the early stage startup banking team. So working with companies from ideation to Series A. My role particularly is how do I work directly with the founders? How do we connect the dots? How do we go value beyond banking, so forth. So introduction to investors, looking over slide decks, and really just being involved in the ecosystem as well. Yeah, so just keeping it short. If you have any questions, feel free to message me on LinkedIn. I'd be there, happy to chat and see how I can help and support. So now back to you, Mike.
Yes, thank you, George. Thank you. And yes, so everyone knows we'll be using the chat function as well. So you'll see Tom's name in there, George's name in there. Feel free to reach out to them directly to get in touch. I will have my email included in the chat towards the end. If you reach out to me, I can connect you to anyone on this call that you want to speak with. But let's get into it. So I mentioned who's joining us on the webinar today. Let's start with Gabby. Gabby Contro, been with Crosslink for 6 years. Gabby, do you mind giving us a quick story, quick intro?
Sure. Hey, everyone. It's great to be here. My name's Gabby. I'm a partner on the team at Crosslink. To give a little bit of background on Crosslink. So the firm has been around for about 35 years. We're based in the Bay Area, and our core focus is early stage venture. So we invest at seed and Series A. We prefer to lead or co-lead rounds of funding. We're a generalist. We take a generalist approach to investing. However, we spend a lot of time in and around software, both horizontal, vertical, which is where I spend a large chunk of my time. And we're just trying to get into great companies as early as we can. We're currently deploying our 10th fund, which is a $350 million fund. We have around 4.5 billion under management as a firm. How I got to Crosslink was, so I actually have an accounting background. So I started my career at Ernst & Young, and made the decision to join Crosslink back in 2013. So I've actually had 2 stints at the firm. So I spent about 3.5 years on the team after I moved from New York out to San Francisco. And then I left, went to get my MBA, and then rejoined the firm 6 years ago. So it's a little bit confusing, but I'm one of the five partners. We're an investment team of 9, and then we also have business development and an organization that's worth checking out called the Alpha Network, alpha.network. And this is a community of founders, CEOs, early stage venture capitalists, and some executives across tech. And we do a lot of community and programming for founders by founders. So that's just an important piece of kind of what we consider our platform here at Crosslink. But happy to answer any questions about us or the firm, but really excited to be here. Thanks.
Excellent. Thank you, Gabby. We're obviously happy to have you. And we'll do a little bit more for everyone in the chat. If anyone wants to get in touch with Gabby, best way to do it is through her LinkedIn. We'll include that in the chat again towards the end, so it's nice and fresh for everyone. But Gabby, thank you for the intro. I'll pass it now to Scott Iyama. Scott, partner with Orrick. Scott, I'll let you do a better intro than I can.
Sure. I'm a corporate partner with Orrick. Really happy to be here. I've been with Orrick about 20 years now. Orrick is a full-service international law firm. We focus very heavily on working with innovative companies and investors, really in the technology, life science, and the finance space. My background is I was actually a bench scientist before I was a lawyer. I was really fortunate, and my PI started a company. I got to watch him go through that process. I got really excited about everything in that environment and decided to go work with entrepreneurs. So my personal practice really focuses on high growth technology and life science companies. Do a lot of work in the SaaS and the AI space. In my career, I've probably done some in the neighborhood of 700 venture deals, multiple IPOs and exits, and have had the great fortune of working with really terrific companies and entrepreneurs, including folks like Gabby and Crosslink. So looking forward to the discussion today.
Great. Awesome. Thank you, Scott. And then last but not least, David Horning. He is the head of the SaaS vertical at Escalon. David, why don't you give us a similar story?
Yeah. So I run the SaaS vertical here at Escalon. I've been doing that for about the past 2.5 years since we verticalized the company, created industry practices. Before that, I worked as a fractional CFO for about 7 years at Escalon. Before joining Escalon, I also worked as a fractional CFO just on my own as a contractor for a few years. Before that, I worked as an investor, stock analyst, fixed income analyst. If you go way back to the beginning of my career, I used to be a mechanical engineer. So at Escalon, like Mike said, we've got CFOs, controllers, accountants that can help with accounting and finance. We've got a full-blown tax team that can help with everything from income tax filings, sales tax filings, franchise tax filings, property tax filings, as well as HR and payroll. So we can help you onboard and offboard employees. We can help you set up a 401k. We can help you set up a health savings account, flex spending accounts, employee handbook. So we really do everything that a full-time back office would do. We just do it on a fractional basis, and then therefore just a lot more cost effective.
That's perfect. Perfect. Thanks, David. Couldn't have done it better. Well, great. Well, let's get into the content of it. I think that's why everyone's here. Like we had mentioned, in the title and mentioned a few times, like the goal is to really cover SaaS businesses specifically here. I think everyone on this call, as we can tell, has like a little bit more general experience than that. But just opening things up, Gabby, I'll start with you. You mentioned a little bit in your intro, Crosslink invests across a bunch of different categories. Like, give me a little bit more on how you guys are maybe seeing the overall startup market today. Are there trends within the specific industries that you guys are focusing on that come up more than others? Like, are there, even areas that you find yourself focusing more on than others, whether it's like SaaS, marketplace, digital health? What's kind of the general sentiment?
Oops, sorry, I was on mute. I think just in terms of this year, I would say it was kind of a slow January and February in terms of, net new deals that we were seeing. But then, ever since then, it's just been, incredibly busy. We're seeing a lot of activity and been very active both at seed and Series A. you're seeing a lot, especially at seed, you're seeing a lot of, either second time founders or people spinning out of large tech companies, starting companies at the inception stage, which is really exciting. And we've made a couple of those bets. And then at Series A, which is a little bit more, I would say the companies that are going out to raise Series A's have been definitely more mature than what we would have seen in 2021. And so and I'm happy to get into that later, just talking about kind of the metrics and the business profiles that we're seeing and so on and so forth. But I think that like the areas, where we've been spending a lot of time, we've been investing in AI for several years. I think, as a firm, we have kind of a core thesis around digitizing kind of slower moving foundational industries like construction and supply chain logistics, financial services, healthcare. And so we're seeing like a big wave of just, businesses coming out of those industries that are able to leverage AI in really incredible ways. So that's, an area where we've been spending a lot of time as a firm, and, we'll continue to do so.
Okay, that's very helpful. Touched on a bunch of things that I think we want to cover. And quick question off to the side, Crosslink, you guys, I know you're based in the Bay Area. Is your guys' firm focused Bay Area? Is it US? Are there any guidelines for that?
So we invest kind of broadly throughout North America. So we've got, a few portfolio companies in Canada, but then for the most part, the rest of our portfolio companies are all based in the US. The whole firm is in the Bay Area. Our office is in Menlo Park, but we have, companies all across the country. So I'm actually in New York right now. We have a big presence here, as well as, other geographies like Seattle, Utah, stuff like that.
Okay, perfect. And then I'll press a little bit more. You kind of mentioned this a little bit, but it's interesting to hear that activity's picked up since January. I've been trying to do in preparation for this call, like obviously there's a lot going on in the market. There's like uncertainty. My guess is you guys have a long tail view of the market, like investing in seed and Series A businesses. Has the news that's been happening affected how your guys' activity is at all, or do you guys tend to ignore that?
It's definitely something we talk about, often as a partnership, and we want to make sure that, we're in businesses that are, resilient to any sort of, recession or downturn. So we actually, go through an exercise that, we started doing around COVID, where it's a resiliency analysis. And so we actually go through our companies and score them on certain things, one of which being recession resiliency and macro headwinds and things like that. And so we're always kind of like looking at our companies and making sure that, they're as bulletproof as they can be for when there is a downturn. But I think like at the same time, there's just like, it's a great time to build companies. So like you're seeing people who are just starting at the inception stage and, build really interesting, going heads down, building product in this economy.
Okay, perfect. That's actually very interesting. Recession resiliency. I'll spin it around. David, if you don't mind, like kind of similar sentiment to the question that I asked Gabby, but like you've got an interesting perspective. We're closing the books of, however many clients every month. I'm sure things have changed quite a bit. Like I love the comparison that Gabby made from 2024 to 2021. Like what are some of the changes that you've seen? How do you think the current market dynamics are affecting those businesses?
Mm-hmm. Yeah. Sure. Yeah. I mean, obviously interest rates are up significantly. They were basically zero for whatever, 12 years or more. So yeah, I mean, risk premiums are up. I'd say the cost of capital is up. Valuations, I wouldn't say valuations are necessarily down. I can't really say that we've seen much in the way of down rounds, but more flat rounds or just mildly up. But I agree with what Gabby said. I mean, now's a really, really great time for companies to put their head down, sharpen the pencil. And set up the business for success going forward. So just as a reminder, during the last economic slowdown of 2008, 2009, some household names got their start, right? Names like Instagram, Uber, Airbnb. Okay, so the same thing's going to happen this time. There are going to be companies that over the next 10 to 15 years, some might even be on this call, that will become household names, and they're starting right now. So I actually think it's a really exciting time.
All right, I love that. Great. And I mean, Scott, not to echo the same question over and over again, but are you guys feeling something similar? I'm sure you and your partners are, covering so many different industries. There's got to be like a fairly robust dialogue happening for you as well.
Yeah, I think I'd agree with everything that's been said. The one piece, I think I'd tack on to that is the exit side. this year, particularly on the enterprise side, there's been a pretty heavy upward inflection just in terms of deal count. There's been a lot of resistance to higher valuations, so it is still a tougher market, but we are seeing deals being done again, and that's been a steady trend that started really towards the end of Q1. I think the most prominent acquisitions we're seeing in the SaaS space tend to be more on the ERP or maybe the CRM, just in terms of deal volume, mostly driven by the PE firms and the PE-backed companies that are buying those as part of roll-ups. But we're seeing kind of a nice trend on the liquidity side of acquisitions start to pick up, and hopefully that continues through the end of the year. And obviously that'll help drive some of the later stage investing as well.
Right. Okay, that's interesting. And on that point, I mean, what is the general narrative? Because I haven't heard anyone really speak about that. It seems like the path to exit for a lot of these companies is through acquisitions, like you said. Is the IPO market closed, in your opinion, for the foreseeable future? Is there a dynamic there? It's better for a company to look for an acquisition than go through like the public market scrutiny?
So, we have a number of companies that are in the IPO pipeline. There's obviously hasn't been very much IPO activity for the last year and a half, and we're not. If you talk to bankers, there is a substantial backup. We're not anticipating an immediate window where we're seeing a lot of folks go out, but we are seeing a lot of near-term deals come up, particularly as we head into year-end on the M&A side. I think David flagged an interesting point. A lot of the buyers slowed down a bit, really kind of around 2022 or so, and they really cited cost of capital. As we're starting to see that stabilize a bit more, and hopefully with interest rates coming down in September and throughout the end of the year, that should free up some more capital to do kind of the medium-sized acquisitions and get more of a deal volume again towards year end.
Okay, all right, that is thoughtful. Good to hear. You don't hear that from too many places. I guess you guys are pretty close to it on the legal side. And I kind of want to actually stay on the topic of fundraising. I know we want to get a little bit into the accounting and the legal pieces of this, but Gabby, I guess kind of a similar question, like the next 12, 18 months for you guys, is there any narratives that you expect to change? I'm sure you guys are looking a little bit at like what a path to liquidity looks like for the investments you make. Like what are you guys thinking about there?
With regards to exits or
yeah. I guess exits and just in general, what makes you excited for companies the next 12, 18 months that would make you want to invest?
Yeah, I think as we I think that there's a big focus on, the companies that we've been seeing are just like stronger, they're more resilient. I think like you're seeing that like, initial traction is like not being valued as high as it used to be, especially at Series A. So like it's definitely challenging to get from seed to Series A. People talk about the Series A crunch that's going on right now. But I think as a result, like you're seeing some like really great companies like mature in between seed and Series A, which gets us excited. So, there's a lot more focus around, growth, but it's very efficient growth. And so, it used to be, people are spending money wisely. There's a focus around just the core fundamentals of a good business. And so I think that's good because, it's setting them up for success. So then when they hit that Series A, then they're just a more mature company for the Series B, the Series C, and then eventually the exit.
Okay, very fair. And that's like a nice dovetail, I think, into like a lot of the reason why Escalon exists, right? Is to try to take advantage of companies, help companies be more buttoned up. Before I jump over there, I did want to follow up on something you mentioned earlier. I think it's really interesting, or interesting enough for the audience to hear from you, a VC that's active in the space. What is a seed company? Like, what are the metrics that look like a seed? What is a Series A company? What's a pre-seed? Like, do you guys do your own division? Because everyone can come in and tell you they're raising whatever they want to call it, basically.
Yeah, so just like as a firm, we're not as strict around specific triggers for us to invest. So we don't say, hey, for a Series A, we need to see, 2 million of ARR. There are a lot of firms like that. We're just not one of them. I think for us, we're looking for at Series A, we're looking for usually at least 6 months of 20 to 30% month over month growth. I would say, for a traditional SaaS business, we certainly would want to be, above 1 million of ARR. Have we made exceptions where we've gone below that? Certainly. And then just, strong referenceable customers, as well as just like the workings of what could be like a very strong, executive team. At the end of the day, we're investing in people first and foremost. And so, we just want, I think, and that kind of translates to what we look for at Seed, where at Seed, it's, an idea and a person. And, we've gone as early as, pre-product, we've gone pre-revenue. And so, with Seed, it's a little bit more, flexibility around what we look for, but it all starts with the actual founder, and just sort of like our belief in that person or co-founders.
Okay. Perfect. Cool. That is helpful. And I'll kind of shift gears then. I mentioned it quickly just before, but David, I'll come to you with this question just because, I do believe that there's this heightened, I'll call it scrutiny on companies, right? People just need to be a little bit more buttoned up earlier than they have had to be in the past, thinking about founders.
Yeah.
What's a typical engagement look like for you with a client? Like I'm thinking a new client comes to you. What are you evaluating first? What are the most common challenges that, you see founders, kind of walking themselves into when it comes to their finance, their accounting, their strategic side of it, that piece of it?
Yeah, probably the number one thing I would say is revenue. I mean, next to cash, revenue is probably going to be the most important thing for a startup to book that correctly. And we do see that pretty common. Clients come in and they've been recognizing revenue incorrectly, either based on invoicing or based on collections. So it's really important that we get the financials GAAP compliant, recognizing revenue ratably over the duration of a contract. So that's one thing. Also, just in terms of expenses, classifying expenses correctly, sales and marketing, G&A, R&D, oftentimes just kind of gets put it into one bucket or it's alphabetical or something. But there, especially around R&D, product development, there's some really nice tax credits on that side. So it's really important that you have that segregated out. On the compliance side, again, SaaS is a little tricky. Some states require that you charge sales tax when you hit certain thresholds on SaaS, and other states you're exempt from sales tax in SaaS. So again, that's something that we can go in there, take a look, and all of a sudden we realize, ooh, geez, you actually have, sales tax nexus in 4 states and you haven't been filing, right? So there's certainly things to do on the compliance side, 1099s and 3921s for option exercises and things like this. There's a lot on the compliance side that oftentimes gets missed with a startup. So we'll kind of come in there and make sure that everything, is done properly going forward.
All right, I like that. Tax is very interesting.
Yeah.
Yeah. Could you actually elaborate a little bit on the revenue recognition piece? If a company's recognizing revenue incorrectly, like what challenges does that create?
Well, I mean, for one, with a SaaS company, pretty much you should be seeing your revenue more or less monotonically increasing month over month, right? It should kind of be going up stair step like this. And when clients go in and they recognize it, say on a cash basis, they might recognize the revenue for an entire year at one point in time when they get paid. So the revenue actually starts to look really lumpy. It's more, like I said, a cash basis, a collection basis, rather than doing it per GAAP, which is you're recognizing it month over month. So when you get when you're recognizing revenue properly, you typically get this nice stair step up in your monthly revenue as you get more and more customers and add more and more contracts to that stack.
Okay, that makes sense. So basically, get a year contract. If you recognize that all 1 month, then the next month, it looks like you're not growing, and then Gabby won't invest in your company is basically what we're talking about.
Well, right. If you have an annual contract that's $12,000 and a customer pays you, you don't get to recognize all $12,000 that month that you collect. You have to spread it out over 12 months. So you can recognize $1,000 in the first month, but then you have to defer the remaining $11,000 and then recognize it monthly. Which is actually a really nice thing with SaaS companies, right? Because you pretty much don't post a zero once you're generating revenue. It's not like a hardware company where your revenue goes to zero on the first of every month, and then you have to build it up as you have shipments. It's recurring. Usually, most of the businesses in SaaS are recurring, so you have that base of the month before of what your revenue was, and it's just additive each month.
That makes sense. Everyone loves recurring revenue these days. Great. Cool. Scott, I'll roll the same question over to you. You sit down with a client, what's the most common challenges that you see where you're like, ooh, you guys are doing that wrong. That's going to lead you down the wrong path. Like, what are some of the early signs?
Yeah, I think the GSB always uses the analogy of the rocket ship, right? It's how fast is the company moving? Where is it landing? I like to remind them that if they're off by a degree at launch, they're in the sun, so it doesn't matter. And so when we're meeting with founders and particularly early stage companies, I think it's really the foundational pieces of the enterprise that become very critical and can cause the most challenges later on. So when we're sitting down with the founding team and really looking at things, it's identifying whether or not the legal construct is really tailored to the business, or is this something that's cookie cutter? Cookie cutter oftentimes gets you in trouble. You certainly want to be within a normal market standard, et cetera, but there's a lot of folks that tend to use certain online platforms, a lot of Google Docs, et cetera, and that really puts them in a bad place from a diligence perspective. Why does that really matter? Most things are fixable, but we don't want legal to ever slow you down. We don't want legal to slow down the business. We don't want legal to slow down diligence, and everything compounds. So when Gabby comes in and is looking at you for your Series A, and your legal construct is a mess, the fund doesn't want to wait. You don't want to wait 4 weeks for the lawyers to try and clean everything up, right? That's an extra $50,000 in cost that should have cost you $1,000 at the beginning if everything was done properly. So one of the things to really be thinking about up front is how diligent you are in creating a good corporate record, putting the governance together, and really getting something set up that tailors to the business, whether or not that's control, that's flexibility, that's liquidity, et cetera, right? It's really getting that foundational piece put together.
Okay, I mean, it makes sense. So it's maybe similar to what David and we try to do at Escalon. It's like removing blockers to allow for growth. Gabby, I saw you nodding along a little bit. Is this something that you guys think about? I mean, you're evaluating a company, like the way that we talk about it at Escalon, right? Is you start a company, you definitely need to find the right legal counsel. You raise funding, you need a bank account. And our hope is that you also are looking for like professional support from a CFO and from an accountant. Like I think there's a lot of value there. Obviously, I'm biased. But what do you think? Is that part of the evaluation process that you go to? Do you see who their legal counsel is?
Yeah, I was nodding because I couldn't agree more with what Scott was saying. And I think it's just so important to do, that strong foundational work from the start. It does, it can be definitely a blocker for us when we look at a company that's just a mess from like a legal perspective or on the financial strategy. Like we invest in a lot of companies where these are very complicated business models and regulated industries, and we need those founders to show a strong ability to understand the numbers and and just partner with somebody, whether it's an Escalon or bringing somebody in house. Like I think it's never too early to look for strong legal or finance support. I think like founders are worried often about costs, but it ends up being more expensive in the long run if they don't build those foundations early. I think that like it's always it's a plus when we're doing diligence and we see a founder who just has like a very strong ability to understand their numbers. They can speak to the assumptions. They understand how much does it cost to actually serve one of their customers. It just gives us a lot of comfort, and I think it builds a level of trust from the start that they're going to be a good steward of capital, and they're doing all the things the right way. So it's definitely like something that we think about in diligence. It's something that we think about when we want to either invest or not invest in a company.
Great. Okay. And it makes sense. It's sort of, you mentioned earlier, you invest in people. It gives the people a little bit more credibility. My thought is that they're looking around the corners. They're not waiting to do a cleanup, but they're preparing accordingly. And one of the questions I did have asked, like I have written down here, which is it's sort of a little bit of a leading question, but for David, like when you're working with a client, like when do you recommend a founder starts working with you? And obviously hopefully it's not like right away. But when is it too late? When is like the sweet spot, would you say?
Yeah, I mean, certainly after you raise your first institutional round of capital, really important that you're working with a professional accounting firm like Escalon. You're going to have investor reporting. It's usually quarterly investor reporting you're going to need to do. You will typically at that point start having regular board meetings. So you're expected to have a pretty professional looking board deck and complete with financial updates. You're expected to have a pretty sophisticated, detailed financial model where you're going in and it's not just the P&L, but you're taking a look at working capital requirements. When are you going to get paid by folks? Cash flow statement, right? So There's a lot that goes into it. Hiring plans, right? So, and investors are going to appreciate this. They're going to want you to make sure that, you know, you're doing your books correctly, but you're also thinking about financial planning. You're thinking about budgeting. Each month, you're comparing actuals to budget and seeing how you're doing. Are you on plan? Are you under plan? If you're under plan, why? Did you overspend somewhere? Why? Did you underspend someplace? So all of this is really important. And then, of course, you can use that to update your forecast going forward, so there's no surprises. Maybe when money came in, you thought you had 24 months worth of runway. 6 months later, you find out that it wasn't 24 months. Maybe it's 22 months, right? Maybe you didn't get a big customer that you thought you were going to get, or you hired a little bit quicker than you thought. So all of this is really important to go through and do that math, do that analysis, scenario planning, sensitivity analysis. It's all crucial.
All right. I like it. I like it. And then I will, Scott, I've got a similar question for you, but just quickly, just so everyone that's listening knows, there's a Q&A function on the Zoom link. We've gotten a few questions in. We'll definitely try to add those to the end of the webinar, but feel free to put anything in there that you're wondering, and we'll try to get to everyone. But Scott, similar sentiment for you. Like, I know that you guys provide a ton of support when it comes to the fundraising process for founders in general. Do you guys, like, what do you guys offer for a super early stage founder? Maybe one before they've even raised institutional capital. Is there a way that Orrick can support those early stage founders before they, you know, maybe have the means to cover like the actual engagement with you?
Yeah, sure. My preference on working with folks, frankly, is to start engaging with them when they're coming up with the idea for the company, right? I think we want to be involved at the earliest stages and really look towards being your partner, right? We want to help protect the company, we want to help protect the ideas, and we want to put you on that glide path so everything is easy. So when we're working with super early stage founders, we defer fees. We also have, and folks are welcome to have access on our website. We make our form system fully available for free. So to the extent that you're looking for base forms, et cetera, you can go to our website and download those. It's the same forms we used with our venture-backed and in some cases our public companies. We want people to have really that clean, clear, and foundation. So, my 2 cents is for if I were a founder, I would find a law firm that starts working with me right when I'm starting the process of what am I going to build? What am I going to create? And help think through that process and get you lined up.
Got it. Okay, great. That's awesome. So there is that support system in place beforehand. And then is there a time where you think it's responsible for a company to actually seek out like your expertise specifically?
Oh, like I said, as early as humanly possible.
Oh, so okay,
right?
So
because
you don't think it matters. Okay.
I think the earlier you are, the more strategic you can be. And I think one trend we've been seeing over the years, right, is there's been a lot of economic shifts over the last 5-6 years. Founders are more savvy, right? Founders are smarter. They are doing more research. They're serial entrepreneurs. We've gone through some bad economic times. We have a number of folks that are on their second and third company. There's a lot of lessons learned, right? And so I think there's founders out there that are really thinking creatively about not just how they're building the commercial aspects of the company, but how they're building their enterprise more generally, right? How are we thinking about creating control? How am I directing the business? And I think those are important discussions to have at the beginning.
Okay, that's great. That's awesome. That makes a lot of sense. Well, cool. And then I kind of wanted to shift gears a little bit. And this sort of plays into the hand of George from SVB, who was on the call. Like from what I've heard over the last year or two, whenever when things maybe started to cool off from the 2021 time, there's this discussion of venture debt. It seems like venture debt is becoming more important. Debt is being looked at as a positive for these companies. Like you can actually use this to fuel your growth in a responsible way. I'll start with Gabby. What is your guys' relationship with those types of offerings for your founders? Like, do you offer any advice to them on that? Maybe it's just a world that you guys don't even touch.
No, we're big fans of venture debt. And so, when we invest in a company, it's a conversation that we have, either in parallel of it closing or right after, the investment closes and they become part of the portfolio. And we want to, we want them to build relationships early with, the SVBs of the world. I think you should do that as early as possible because, while it might not be on your radar right now, I think it's great to start small, and then, somebody like SVB, you can grow with them and they can grow with you, and, expand the product offerings like outside of just venture debt. And we've had a lot of companies do that. We actually just had two seed stage companies that, one person might think that's maybe too early to explore venture debt, who have closed facilities with SVB, and they've just been like really, really great partners. And I think it's just a really smart thing for founders to start building those relationships early.
Great. Okay. George, I saw you just pop the camera off. I'll ask you a quick question. What is I'm sure it's different for every company. So try to give me like a broad strokes answer. Situation like Gabby, seed stage company looks for venture debt. Do they need to have revenue to get venture debt? When should they have that conversation with you?
Yeah, for sure. So, it's also really important to make sure that, you have a lot of your, your metrics in place. The main thing for us is that we don't have a very specific, I guess, milestone you have to hit. It's just more so on overall the founder, who's the lead investor, how much revenue have you gotten. That's pretty much all part of the underwriting process. But, again, the main thing for us is that our whole business is purely on working with the innovation economy and working with companies that are raising funding. So it's really close working with our investor relations, like Gabby and Crosslink and others as well, to really create a complete picture and figure out, okay, what's a good time for us to come in. Luckily for us, we're actually piloting a seed debt lending program from the SVB side. So that's something that it's exciting that's coming in the works as of right now. So as of right, it's more of really case by case, more so just reaching out to seeing like what are kind of the milestones. And again, it's depends on where you are in terms of the industry. There's just so many factors you want to throw into it, but from a very general perspective, revenue is always a big part. Kind of really finding your product market fit. It's having those month-to-month growth and really just taking it from there.
Great. Okay, I love it. And David, I'm going to ask you something on a similar sentiment. Like, and this is a question that's come up in the Q&A channel, but venture debt versus like revenue-based lending. I know we were speaking with someone that does that recently. Do you have an opinion on one of those things? Is one better than the other? Does it depend on the company, or is it just case by case? Can't offer a general opinion.
That's for me.
Yeah.
Yeah, I would say, just case by case. I mean, I usually see clients do a lot more on the venture debt side of things. Okay, so there's an interest only period and a pay down period, and that I would say that's probably 90%. It just tends to be the most popular. Obviously, for revenue-based lending or AR factoring or whatever, you have to have revenue. And the amount you can borrow will fluctuate as that revenue or those collections vary. So, but I'd say for the most part, most folks have been doing just the straight venture debt with like an interest only period of a year and a half, and then have 3 years or so to pay down. And then the other nice thing too is it also can be refinanced. So I know SVB has done this many times with clients of mine. They'll be paying down a loan, and then they'll do another round of financing. They go out and do it, let's say a Series A or a Series B, and then they refinance it into another venture debt facility. So that works well also.
Got it. All right, I like it. Cool. And I want to make sure that we finish within an hour. There's a few more Q&A questions that we can try to get through, but I'm just going to kind of send around the horn, starting with you, Scott. Just generally, what are you most excited about when it comes to this technology space? You're obviously a technologist. Like next 12, 18, 24 months, obviously AI is something that people keep talking about. Is there anything specific that you find most exciting?
I think AI is going to be the most exciting piece, right? I think particularly when you're starting to think through, kind of the analytics collaboration space, bespoke healthcare delivery pieces. I think there's so much opportunity and growth there. Particularly on the SaaS side, it's really, really exciting. It has a lot of really interesting legal issues right now. The three big ones that we're looking at are really on the compliance side. Happy to chat about those, but that's I think where there is more regulatory, there's also a lot more opportunity for innovative companies to create a market grease for them to really be opportunistic and scale. But AI, I think, is really, it has been for the last year, and I think it will continue to be the most active space for us for sure.
Yeah, could I click on that? I actually did want to ask you about the legal like application to the AI space. And frankly, I don't know if I know enough about it to ask a sophisticated question, but that's perfect. What are some of the biggest challenges? Maybe try to keep it simple for the audience, but when it comes to compliance, is there a common problem that most people see, or what's advice that you could maybe give to some founders that would share them or spare them a few hours of speaking to a lawyer formally?
Sure. I think anytime you have a very hot space, right? Regulators are a little bit of cork on the river. And so there's a lot of scrutiny both at the state and the federal level. I think the three big areas where you're seeing a lot of regulatory in AI, one is at the state AG level. So attorney generals are really focused on public safety, consumer safety, et cetera. Right? I think that's going to be their biggest focus. At the federal level, there's, I think, two layers. One is the SEC and the DOJ. One of the big trends that we've seen over the last 3 months, frankly, and that we're hearing every time they talk, is AI washing. I think that's going to be a very, very hot area on the compliance space. We're already starting to see the SEC penalize and come down on some companies. AI washing, just for folks that aren't familiar with it, it's when a company makes an overinflated claim based on AI. Often happens in the investment space. It's really kind of the large, broad prospective statements that you could make to an investor, or in the healthcare space, a patient. And then the third space that's really it'll also be largely affected by the outcome of the election, is antitrust. Right? That is a really key focus of the FTC and DOJ. Where are not just these acquisition deals going, but where are these partnering deals going? As SaaS companies are starting to use unified platforms, they're using the same LLM places. What is happening is that the antitrust regulators are really focused in on, when you're working with certain customers, when you're working with certain partners, does that create antitrust concerns? I think those three kind of hotspots are really going to pick up over the next 12 months.
Okay, perfect. That's great. And Gabby, I'll send it to you next. Similar question. What are you guys most looking forward to? Are there exciting industries, exciting trends, any of the above?
Yeah, I mean, I think we haven't even scratched the surface of what AI is capable of. I think personally, in an area where we're spending quite a bit of time at Crosslink, is this wave of software enabled services businesses that are leveraging AI in pretty incredible ways. So calling them kind of AI native services firms, where there's kind of a hybrid human plus AI model. And I think that those models have the ability to really transform a lot of these services based industries, whether it's recruiting and design. And I think there's a lot of interesting things happening in and around medicine and dental, and the list kind of goes on. But I think there's just some fascinating companies being built in and around that, and almost like a business in a box for these slower moving industries. And I think that that's at least where I'm spending a lot of my time, and excited about what's being built there.
All right, I like it. David, you like AI as well?
Yeah, I mean, obviously that's going to be huge. I mean, the thing that's kind of neat about the SaaS space is it's really more of a tech platform business model, if you will. It applies to all kinds of industries. We see it in energy markets. There are SaaS companies that are getting into energy markets. There are SaaS companies that are getting to healthcare, ed tech, clean tech, materials. It's really covering everything, financial services. So AI has the potential to revolutionize kind of all of these industries through a SaaS platform. So yeah, it's a really exciting time.
All right, great. Well, cool. Well, awesome. Well, that wraps up, everything that we wanted to cover. We've covered most of the questions in the chat as well. So I'll start where I'll kind of unwind things by letting everyone know, if anyone wants to get in touch with the group on this call, feel free to reach out to them on LinkedIn, or you can find Scott Iyama's profile on the Orrick website. Gabby's on LinkedIn. Feel free to send her messages. David as well. If you've got questions, I'm sure they'll be willing to answer them. And then, if there's anything else, or you forget anyone, anything like that, feel free to reach out to me. Like I said, my name is Mike Wiesenfarth. I'm the head of partnerships with Escalon. But Gabby, Scott, David, thank you for joining today. George and Tom, thanks for sponsoring, and we'll see everyone next time.
Perfect. Thanks, guys.
Thanks, everyone. This was fun. Look forward to staying in touch.
Yep. Thanks, Mike.
Everyone.